I want to talk about shares versus property because we get it all the time. My favourite is both. I reckon you've got to have property, you've got to have shares. And we want our clients to have property and shares. So shares, you can sell them pretty quickly. You can get the money in a couple of days. If you've got a managed fund, it takes a week or two, and they're divisible. So you can sell part of your portfolio for money should you need it. Property, it takes more time. It can take from weeks to months to sell it, and it's not divisible. So you can't eat bricks. You can't eat a window. You can't sell the back ensuite for cash. You've got to sell the whole property. Risk. So they both carry risk. Shares you can diversify. They carry a lot of market risk, and they're volatile in the shorter term. Property, it's harder to diversify, but it's easier to manage because you've got a less of an asset. It's more tangible. It still carries market risk, and the volatility is less visible. What I mean by that is they're not valued daily. So quite typically, if we're going to invest in a property, we'll value our property, but it's not valued every day. But if I got a bloke with a Ray White auction hammer out the front of your house and it was valued every day, I promise you it would look like the share market. But it's just not valued daily, and you don't get people at the end of the weather talking about how the market's crashed or gone up, etc., etc. So then you got the whole maintenance management piece. So shares, you've got to do a bit of research initially, and you need ongoing research. And there's not a lot of ongoing maintenance costs once you buy them. You really just pay to sell them. You pay a bit of brokerage to sell them, and there's pretty little ongoing management. Property still require a lot of initial research as well. It does need less ongoing research because, you know, it doesn't change as much as a stock. Ongoing maintenance costs and management of tenants and property. Tax. Good old tax. And finance. So shares, you pay capital gains tax when you sell them, but you can also get these franking credits with shares, which a lot of people don't take into consideration. Shares are two-dimensional. You've got capital growth plus income. And a lot of those dividends in Australia are franked because that company's paid tax on that income first, and you get a credit back for those dividends. And you can use about 70% for security. Banks are more comfortable with property. Property, you can get good depreciation, good deductions. You can buy a bigger asset. You can borrow more dough. If you've got some, you know, you're paying a bit of tax, property's good because you can get some really good sized deductions, and you can borrow more against it.